Well, good afternoon. This is Damon Hininger, CEO of CoreCivic. It's a beautiful sunny day here in Brentwood, Tennessee, and we're very, very proud and honored to be part of the group of investors presenting, I should say, for the Noble Conference. So Noble, thank you for having us. We're, again, very honored to be here and spend a little time with you this afternoon. Again, Damon Hininger, I'm CEO and President. I've been with the company about 29 years and about 11 years as CEO. To my left here is David Garfinkle, who is our Chief Financial Officer. He's been with the company almost 20 years, but has been our CFO for the last 6-7 years. So really, both of us appreciate the opportunity to spend a little time with you. Also with us, although outside the camera range, is Cameron Hopewell, who's our Managing Director of Investor Relations. I'm going to lead us off through a couple of slides that we've got here on the deck. This presentation actually will be available on our website, CoreCivic.com, after today's conference, so feel free to look that up and take a look at it more closely after today's presentation. I will start my comments today on slide number 3, which just talks a little bit about the company, a little bit of an overview of who we are and what we do. So the last 12 months, ending September 30th of last year, our total revenue on an annualized basis was about $2 billion, and we had about $3.8 billion in total assets, and nearly 19 million in square feet that we own with our real estate. We do 3 key things that you see there in the bottom left. We do safety, properties, and community. So what we call CoreCivic Safety, that's where the company was founded back in 1983, doing owned and managed or managed only solutions for federal, state, and local government for detention, jail, and correctional settings. Well, more recently, we added 2 new solutions, which we call CoreCivic Properties. That was established around 2012. Where we provide mission-critical real estate to government partners where they're the landlord or the tenant. And then also around that same time in 2013, we started CoreCivic Community, where we own and operate in many cases correctional facilities, reentry facilities that are helping individuals in those last few days before they get released back into their respective communities. So CoreCivic Safety, Properties, and Communities. So as we go to slide number 4, gives you a good overview of kind of our footprint in the United States. We're only United States based. We don't do anything internationally. And again, if you look at 3 segments, safety, properties, community, the bullets here on the left give you a good overview of how much we do in those different segments. So safety, again, is where the company was founded 40 years ago. So that's the majority of our business at the moment. Almost 84% of our NOI comes from the safety segment, and about 15 million square feet that we have within that business unit. Properties is, again, growing part of our business and a relatively newer part of our business. That's about 13% of our NOI comes from that piece of that business unit, I should say. And that's just over 3.3 million square feet that we have under that segment. And then finally, the community segment, again, was started around the same time, 2013, about 3.5% of our NOI. These are smaller facilities. There's typically 50 to 100, maybe 200 beds. So they're smaller from a real estate perspective. So about just under 1 million square feet and about 5,200 beds total. And if you look on the page 5, the next slide, gives you, again, a little bit of a different breakout of the 3 segments. But kind of the key point here is that we do business exclusively with government. So all of our customers or tenants are government jurisdictions at the federal, state, and local level. And it also gives you a little bit of a sense here of what the industry trends and the value proposition. Let me switch gears a little bit and move to slide number 6. And we had a big announcement last year, and that is converting from a REIT to a CCorp. And so that was effective this month on January 1st of this year. Being a CCorp is not foreign to us. We had been CCorp in prior times in the company's history. In fact, from 2000 to 2012, we were structured as a key CCorp. So we know that structure, but we also know that structure does not impact our ability to grow the business or to operate our facilities. So effective this year in 2021 will be a CCorp. And this has been a little bit of a journey. So starting in probably late 2019, we started a conversation with the board about looking at, what's the appropriate business structure as we think about kind of the future, the needs of the business. But also, clearly, as a shareholder and as representatives of the entire shareholder base, we were not happy with the trading multiple. So we're thinking about not only the corporate structure, but also not getting credit that we think is deserved within the equity markets. We're also thinking about maybe some limitations that the restructure puts on us. As many of you know, restructures don't allow you to do healthcare facilities. And so as we think about needs, especially in government for mental health or medical or chronic care or infirmary beds, that is a business solution that we could not do under the restructure. We've also feel like we've been unfairly mischaracterized as an ESG investment. ESG is very near and dear to our heart and to our mission as a company. I'll talk a little bit this later, but we feel like we didn't get complete appreciation or are getting complete appreciation of the important work that we do that are very positive from an ESG perspective. But also we saw here in the last couple of years some pressure, political pressure especially put onto our banks, and that in turn they made decisions to either not bank the company any longer or maybe didn't want to do work with the industry any longer. So taking that all into account, and again, getting we think, fair credit for the value of our services, but also the underlying value of our real estate, led to a conversation with the board starting again late 2019 to where we made the final decision last summer to convert from a REIT to CCorp. And we're very excited about this conversion. It really gives us great flexibility on several fronts. One of which is it obviously improves our credit profile dramatically. So having our cash flow in hand, or we can deploy that cash flow in the most attractive and highest return, gives us a lot of flexibility. Versus being a REIT, we were dictated to move most of our cash flow out in the form of a dividend to shareholders. Obviously, it also is going to lower our cost of capital over time. And with that, lower our dependence on capital markets, give us a lot more flexibility that if the capital markets are not open from a period of time for whatever reason, we can use our cash flow to pay down debt maturities. We also think it gives us greater flexibility when we amend and extend our credit facility, which right now doesn't expire until 2023. But when that point comes up to where we have to amend and extend, probably don't need the size facility that we have today. So that gives us obviously a lot more flexibility too. But also gives us opportunity to build and grow the company in different ways. As I said earlier, we've got opportunities maybe in healthcare, medical services, maybe providing mental health facilities to jurisdictions where maybe we're just the landlord and they can be the tenant. So it gives us opportunities to grow in different parts of the market that were not available to us as the REIT. As we stated with this conversion, we do want to pay down debt maturities and get our leverage to kind of in a range of 2.25 to 2.75. So that is our goal that we have set forth and our really number one priority here in the near term as we convert to a C-Corp. But getting past that point, obviously gives us a lot of flexibility too to where we can go out and be active buyers of our shares with a share repurchase program. Again, that's playing the playbook that we've done before. We are an active buyer of our shares back in 2009 to 2011. So that's a tool that's available to us more easily, I should say, now being a C-Corp. And finally, obviously allows us to grow the company, again, not beholden to other markets, maybe capital markets or the equity markets. We can, again, fund a lot of new growth with the company at the appropriate time once we get through some of these near-term priorities with that cash flow. Let me switch gears and just talk a little bit more about how we're looking to pay down our debt and lower our leverage ratio. So if we turn to page number 7, we've conveyed to the market and actually have completed one transaction already, but we're looking to sell some non-core real estate assets. We had some assets that were high value, very, very good returning leases with these assets that just wasn't getting its appropriate valuation, we believe, within the current structure. So we started a process last summer. We had tremendous response back from potential buyers. Real estate, especially real estate that has federal GSA leases tied to it, are very attractive in this moment of time, whereas real estate investors in the equity markets are looking for good yield but also low risk. And these type of assets are very attractive at the moment. So we saw a really good market opportunity to go out and see if these facilities could be sold, or these assets, I should say. So we've done one transaction already in the last year. That was 42 properties, and that was a total sale of about $106.5 million. And we've got the remaining part of this portfolio still in the works. We're feeling good and feel like we've got really strong interest for these assets. And we feel remain confident, I should say, that selling these remaining assets should net in the proceeds about $150 million. And that will be used will just turn around and be used to pay down debt even further. So that's a great way we can accelerate that strategy. So with that, let me turn it over to Dave Garfinkle and talk a little bit about the financial position.
Thanks, Damon. So on page 8, we just show really the durability of our cash flow. So you see over the past 10 years, we've generated adjusted EBITDA somewhere around $400 million plus, and that's through multiple economic cycles, obviously. Down the bottom right-hand corner, you can see where we returned capital to our shareholders prior to our REIT conversion in 2013. When we originally converted to a REIT, we bought back from 2009 to 2011 about $500 billion worth of stock. So that's really part of the capital allocation strategy that Damon described. And converting from a REIT to a taxable CCorp, we'll have the ability to retain that cash flow. Once we de-lever, if the stock price hasn't responded, we'll have that ability to, again, to repurchase significant amounts of stock, something that we really didn't have the ability to do as a real estate investment trust because of the dividend requirement as a REIT. Moving over to page 9, you can see, the last 4 quarters of financial performance. We have been impacted by COVID-19, primarily by Immigration and Customs Enforcement, as the southwest border has been shut down in order to protect the health and safety of the American citizens. But nonetheless, we've continued to generate significant cash flows. In fact, you can see in the bottom row there, we've actually had increasing cash flows throughout the pandemic. Now, part of that's due to positive changes in working capital, but nonetheless, you can see that our cash flows are durable. We've got A-rated tenants. They're all government, as Damon mentioned, and pay their bills on time and don't have to worry about a lot of credit or going dark because of the credit quality. So significant cash flows and a conservative leverage profile of just north of 4 times, and that's each quarter. On a trailing 12 months is just under 4 times. And we've continued to make progress on that as we suspended the dividend in the middle of last year. So have used that cash flow that would have been used for dividends to pay down debt. So expect that leverage to start moving substantially below 4 times shortly here in the current quarter. Moving on to page 10, you can see we've got a conservative balance sheet. As I mentioned, debt leverage profile has typically been a little bit north of 4 times. As we expanded in the property segment, where you have stable cash flows, more stable cash flows than even the safety and community segment, where your rents cash flows based on fixed monthly rents in the property segment. That leverage profile for that segment's grown a little bit, and it's resulted in a blended leverage of just over 4 times. As we've disposed of a part of that portfolio and plan to dispose of a larger part of that portfolio with several large government leased assets, we'll be able to pay down debt pretty rapidly. And as Damon mentioned, targeting a leverage of 2.25 to 2.75 times. It's a manageable debt maturity schedule is also presented on page 10. I'd say that of the $996 million maturing in 2023, we do have $282 million of cash on hand. This is as of September 30th. So it's a little bit misleading because the net debt's much lower than that, but certainly a manageable profile. We've got $250 million of debt coming in 2022, another $350 million of unsecured notes coming due in 2023. We'll be able to pay off the 2022 notes with cash on hand and cash generated between now and then, and we'll make significant progress in paying off the $350 million of unsecured notes before then as well. The bank credit facility is included in there, so we've got a term loan A and a revolving credit facility that are both included in that maturity in 2023, and we'll look for an opportunity perhaps in 2021 to amend and extend that facility, but certainly would look to do that in 2022 if we don't do that this year. Moving on back to you, Damon, under market updates and recent developments.
Thanks so much, Dave. So yeah, we'll go to page number 12 here. And this is a good slide. It talks a little bit about both the state and federal partners that we do business with, kind of what their challenges are, and some of the work that we do with them, and some of the uniqueness of their needs. So start on the left side with state partners. Some of the key challenges that we see with them is one is prison overcrowding. So that unfortunately has been a chronic problem for a lot of jurisdictions for several years around the country. Compounding that, though, is that they've got aging and insufficient infrastructure. So many jurisdictions have 40, 50, 60, even over 100-year-old prisons that they're operating today still that creates real challenges for them. And it's even exacerbated here in the last 12 months with COVID, where they've had real challenges just because that's aged infrastructure. It makes real challenges on doing quarantine or having infirmary beds or having modern systems where they can turn over air in housing areas and other service areas. So real challenges on that front on the state side. And along with that, this comes a little bit in cycles, but budgetary constraints too. And so our partners on the state side, they have seen obviously ups and downs here in the last 10 years with the Great Recession and also the impact here most recently with the pandemic. We can come in with a solution, which is a new modern facility that has, all the appropriate design features that make them not only efficient from an operation perspective, but deal with some of the challenges they have, near term, like the pandemic and a virus that was exacerbated with COVID-19. But also we can provide some real cost savings to them too, based on operating costs that they may have gotten in their own system, especially with these older facilities. We've actually put a number, to talk a little bit about the property side, we've put a number of about $15 to $20 billion in infrastructure that needs to be modernized in the United States. So really big number. And I've got a chart here a little later on the deck that gives you a sense of how many facilities that is. Flipping to the federal side, some similar challenges, limited owned infrastructure, especially on the federal customers, ICE and Marshal Service, where they have a law enforcement mission. Also, they have constantly shifting geographical and population needs. And so that gives us real flexibility, provide real flexibility, I should say, to our jurisdiction where we've got capacity based on kind of priorities or demands based on what the priorities are relative to that jurisdiction. But finally, and probably most importantly, we provide an appropriate setting for detainees. And these could be federal prisoners under the Marshal Service or detainees for Immigration Customs Enforcement. So when we design a facility, we understand not only the national standards for American Correctional Association and other jurisdictions, but also we understand deeply the standards for those two jurisdictions, what they expect from not only a design perspective, but also quality and services. So we make sure we design and staff and put forth policies from an operation perspective to meet all those appropriate standards. But we also make sure that our facilities can be most efficient for their mission. So we build also the courtrooms, maybe space for attorney staff or attorneys and case managers. So really it helps them have a centralized geographical location, ability to be most efficient for their mission. Final thing I'll just say on this slide, staying on the federal column there on the right, is the uniqueness of ICE and Marshal Service relative to how they use the private sector. So ICE, virtually all their population are housed in either facilities like ours in the private sector or city or counties, local jail or detention facilities. So they virtually completely outsource that need to other agencies, again, either private sector or city and county governments. Marshal Service do virtually the same thing. They do have some population they house with the Federal Bureau of Prisons, which is also located in the Department of Justice, but virtually all their population is outsourced, either to the BOP, cities or counties, or private sector like CoreCivic. So that's a very unique characteristic versus a lot of our other partners on the state side and the Federal Bureau of Prisons. Switching over to slide 13, we've had a really good period of time where our value proposition continues to resonate and manifest itself in actually new contracts. So if you look here at the deck, and I won't go through all these, but I do want to highlight a couple of them, one of which is the most recent one, and that's in October 2020, a new agreement with the Federal Bureau of Prisons for some community correction beds in the state of Oklahoma. So that'll go in our CoreCivic community segment that I mentioned earlier. I also want to note right underneath that a new contract with the United States Marshal Service at our facility in Cushing, Oklahoma. So this will be in our safety segment where we are housing and operating, and we own this real estate, a solution for the United States Marshal Service, both for the districts of Oklahoma, but also their JPAS, which is their transportation system. And the other one I want to highlight, which is a little further, is that we are holding or I should say we are leasing capacity to the state of Kentucky in our Southeast Kentucky facility. This is a facility that we own, but the state of Kentucky will operate, and is operating, I should say. So all three segments is my punchline. All three segments here in the last year have gotten new contracts or leases. So all three of these solutions are being very attractive to jurisdictions all over the country, federal or state, and different ends of the political spectrum, I should say, too. So again, our value proposition has and continues to resonate for all the reasons I talked about earlier. And the last thing I'll just say on the slide, you see there on the punchline, in the last these last new 9 contracts awarded or activated in the last 2 years represent almost 10,000 beds across 9 CoreCivic facilities. So again, we've had a good, strong run here in the last 24 months providing our solutions to federal state jurisdictions. Let me switch gears and go to slide 14 and just talks a little bit about the history of the company. We started off in 1983 providing on the first column, which is called early stages, operational cost efficiencies, and this created a new business solution that we called managed only. And these were assets that were owned by the government, but we were a tenant and we provide the solution. So this is a way for the government to quickly activate a lot of capacity in their system. If they weren't able to do it themselves, they could look to the private sector, the company, to provide that operational expertise. But we also, during a period of time, started the very first solution where we owned and managed the solution to the federal government. So that was in the early stages of the company's history, those type of solutions to federal and to state jurisdictions. In the middle, which I would say kind of is kind of late 90s going up into kind of late 2008, 9, 10, this phase, we saw a lot of growth to the segment of where we own and we operate facility, again, what we call safety today. This solution provided a lot of flexibility to jurisdictions, especially if they're growing quickly, but also didn't have the capital to deploy to build the real estate. So we could come to the table with a complete turnkey solution, own and operate. And we saw that not only work out on the federal side, but continue on the state side, but also on the federal side. And then finally, the current market, here's what I would describe what we're seeing now. We're seeing populations grown, or slow, I should say, from where they were, say, in the 80s and 90s. And so with that, the solution back in the 80s, which was managed only, that part of the business we have divested out, where we had about 20% of our revenue on the managed only side in 2010. That's now about 7%. So we've divested and it's transitioned out of that business. But we also, as I said earlier, are seeing tremendous need for how can we help a jurisdiction deal with their aging correctional infrastructure. And so we've had some great successes from California to Oklahoma. We delivered a new facility in Kansas early last year, and we've also been selected to negotiate up to 2 new leases in the state of Alabama. So this is a very much part of the growth story for the company going forward, where we can provide real-time, cost-effective, on-time real estate for jurisdictions who are looking to consolidate and maybe close a lot of old, antiquated facilities. But we're also still seeing strong support and need, I should say, for existing capacity. Again, you saw on the previous slide not only the Marshal Service in Oklahoma going to our Cimarron facility, but Idaho signed a new contract for capacity that we've got in Arizona and also Mississippi about a year ago. So that continues to be a very strong part of our value proposition. And then finally, the continued federal needs. The federal needs are with ICE and the Marshal Service, and that need continues to be very, very strong. Again, where we can provide appropriate capacity at high quality, customized for their need and mission in the right geographical location. So let me switch gears a little bit. We'll switch over to slide number 15, Cameron. And again, I won't go through all of these, but I just want to highlight our real estate is very flexible too. And so facility, and I'll maybe point to a couple here. Our Cimarron facilities I mentioned earlier, that initially was built in the 90s for the state of Oklahoma. But now the primary user of that facility is the United States Marshal Service. So great flexibility. We're going to go from a state partner to a federal partner at the same facility. We've also seen places like North Fork, which is out in western Oklahoma. That facility has held a couple of jurisdictions over the years since it's been built. Oklahoma, Wyoming, I think a couple other out-of-state solutions. California was also a user of that capacity at a period of time when they were getting through their overcrowded crisis back in 2006 to last couple of years. But now that facility has been flipped from the safety side, where it's owned and managed, to where it's now under a lease with the state of Oklahoma. So they're the tenant, they operate it, we just provide the real estate. So punchline on this slide is that our real estate's very flexible for alternative uses, but it also is attractive nationwide. We could have a facility in Oklahoma that houses inmates from the state of California, or locally to the state of Oklahoma, or maybe the United States Marshal Service out in western Oklahoma. So a lot of not only flexibility, but also marketability nationwide. Let's switch over to page 16. I want to just reinforce the point I made earlier, and that's the aging infrastructure crisis. So this is from a recent trade magazine where it says since 1960, there's actually between 1980 and 2000, there is about 500 prisons that are in need of a major upgrade, repurpose, or replacement. And unfortunately, one of the challenges that government has, especially on the state side, is that they build a facility, but they, unfortunately, because of maybe a tough budget environment, they can't keep up with preventive maintenance. Or, again, it could be a 50 or 100-year-old facility, and it's just not consistent with current correctional design and have not only the appropriate, efficient design from an operation perspective, but also doesn't have the appropriate systems to deal with the pandemic that we're unfortunately in right now. So, again, to reinforce what I said earlier, we've estimated there's probably about $15 to $20 billion in development needs in this segment alone, where we can help modernize correctional systems with their aging infrastructure. Let me slip over a few slides to go to page 19, where we'll wrap up before we go to Q&A. And that is, we have now gone through our second cycle of reporting our work under ESG. ESG, as I said earlier, is very near dear to our heart. It is where our passion and where our mission is focused in on. We have a mission where we really work hard to make sure that people entrusted our care are in a safe, humane environment, but also have an opportunity for programs and other services to help them deal with the journey once they get released back into communities and they can gainfully get employed and also get reunified with their family. So the ESG platform, what it really does is just gives a great transparent view into our operations and the great work we do. So let me give you a couple of examples. One of which is here in the last 5 years, we've helped 30,000 people either get their high school diploma or GED or get certified in vocation, maybe as a welder, maybe as a mason, maybe as a computer coder. And studies have shown clearly, and this is common sense, I know, but studies have shown clearly that if you help someone get to that point, they're 40% less likely, once they get released, to come back in the criminal justice system. So obviously it has a tremendous impact on recidivism rates around the country. And we're really, really proud of that work. But what we've also noted in the ESG report, among other things, it's really, really comprehensive, this report on showing what we do as a company and our passion for our mission. We have here in the last 4 or 5 years started lending our voice to criminal justice reform, notably around things that help people while they're incarcerated, but also maybe some of the challenges and hurdles they have once they get released. So we have lent our voice in not only words, but in support to candidates who have said this is an important part of their platform. So, for example, ban-the-box legislation, that's one that we started lending our voice to several years ago. But more recently, with what we call Policy 2.0, which is again highlighted in some of our materials, we lended our voice to Pell Grant restoration. As you may know, the crime bill back in the 90s took this off the table for people incarcerated, where they could get Pell Grants and have the ability to go to secondary education organizations or institutions. And so along with that, voting rights registration, licensure reform. Bottom line is we really have seen that we've got a good platform that we want to take advantage of and lend our voice to a lot of these really, really good policies at the end of the day that help the people not only in our care, but the people that are here in the United States that are on the journey back into society. And again, with that, not only lower the hurdles, but make it less likely to come back into the criminal justice system. So with that, as we wrap up, I'll open it up for Q&A.
Damon and David, thank you very much. Very informative. My name is Joe Gomes. I'm the Noble Analyst on CoreCivic. We're going to start the Q&A session here. If you wish to ask a question, please click on the lower right corner of the video window. I'm going to start it off with the big picture here, seeing what's going on today under the Biden presidency. Just getting your view. He's talked a lot about ending private prisons, even though, as you just demonstrated, a number of states are looking to expand their usage. He's talked about changing immigration policies. what do you think, in your best guess at this point, early point in time, the impact could be on CoreCivic?
Great question, Joe. And yeah, to your point, a momentous day in our country. I saw the ceremonies today, and beautiful sunny day there in Washington D.C. Obviously, wonderful country that we lived in. We've seen democracy in action again with the peaceful transfer of power. So, a powerful day, powerful message, and powerful visuals coming out of Washington D.C. So, as a patriot, that warms my heart. To your question, we've been around almost 40 years. And so we have seen Democrats and Republicans control the White House. We've seen Democrats and Republicans control governor residences all over the country where we've done business. During that 40 years, at one time or another, we've done work with almost 30 different states. Today, I think the count official customers on the state side is around 20. But at one time or another, we've done work with about 30 different states. And so what we have shown and what we have demonstrated is that regardless of who's in the White House or regardless who the governor is, we provide a good, flexible, cost-effective, high-quality solution to our partners. But we also know, and this is part of the value proposition, is that we can be very flexible because their needs change. And so to give you an example, the Federal Bureau of Prisons, the largest correctional system in the country, the Department of Justice, their needs have changed since 2013. There's been some very, I think, smart, proactive changes as they think about criminal justice reform that's changed their needs. And in turn, you go from 2013 to today, I think they're down, and this has been somewhat exacerbated with the pandemic, they're down 70,000 individuals in their care, which is a very large number. And so we understand that jurisdictions' needs change. Our solution may be a short-term or a long-term solution based on that jurisdiction. And then with that, we navigate through that as a way where we can not only be flexible, but also know our real estate and our solutions are marketable locally, but also nationwide. But I'd also say ICE and Marshal Service, so the two other agencies we do business with at the federal level, their needs are very specific, but also not only the solution itself and the service we provide, but also the location. And so one thing we think we do really, really well is just making sure that the needs for ICE, the needs for the Marshal Service, understand geographically where that need is, what's driving it, how can we be part of the solution. And so we've demonstrated over different administrations, going back to Bill Clinton in the 90s to George Bush, and today with President Biden, our solutions are great from a location perspective, good service, high quality, meet all the appropriate standards. And with that, as I said earlier, both ICE and Marshal Service, they have a law enforcement mission. So they continue to look on either the private sector or cities and counties for capacity. And I'll be biased, but I think it's very true. We do it a lot better than cities and counties. We make sure we follow the appropriate standards. We design our facilities as appropriate, but we also add the services like transportation, space for judges and courtrooms to where we can help the marshals and ICE be a lot more effective in the mission. But what would you add to that, Dave?
No, just to emphasize the standards that we comply with. Our facilities are larger. We provide an easier logistics for Immigration and Customs Enforcement, for example, where we've got a 1,000-bed facility. If they've got we may even have a court within that facility as opposed to a local county jail. If they've got to round up a bunch of people from various county jail systems and bring them to court, that's a logistical nightmare for that agency. So we provide that value by either having a lot of people in one area, or in some cases even providing that courthouse within the facility. And again, we meet the performance-based national detention standards that are issued by the government agency. And just because of the physical plant, oftentimes the local county jails can't meet those standards. So I think you covered the rest of it.
And one thing I would say, and this is probably an obvious point, but it's an important point, under the Obama administration, which obviously President Biden, then Vice President Biden, was obviously part of that administration. That administration came to us in 2014 when they were dealing with a real challenge on the southwest border. They had a significant amount of families coming to the border, and they needed a safe, humane, purpose-built facility that was appropriate for that population. And after a couple fits and starts, they realized that the private sector, notably us, CoreCivic, provide that solution. So we're very proud that we got that call in 2014. This facility, which is in South Texas, just south of San Antonio, provides a great solution for ICE for the housing of families. And again, that facility was built day one for that mission. So it's not a retrofitted prison or detention facility. It's a family residential center for that mission. And so we think, under his leadership, under the prior, or I guess under the Obama administration, we once again showed the solution how we can provide a thoughtful, safe, and humane environment to the government at a really, really challenging time for them.
Thanks for that in-depth answer to the question. We've got about 5 minutes here remaining. We've got a couple of questions on the leverage ratio. I'll throw both of them here together. One is any guidance as what the company's leverage ratio will be at the end of 2021, or when do you think you might be able to get to your 2.5 times leverage ratio?
Thanks, Joe, for that question. It's a little bit uncertain given a lot of the uncertainties around the pandemic, immigration policy, and so forth. But we think we could probably be in the mid-threes, maybe a little bit lower than that by the end of 2021. I think we'll probably, come in under 4 times by a few tenths of a turn for the year that we're closing the books on right now. It'll probably take a couple years for us to get down to that targeted leverage ratio, the midpoint being 2.5 times total net debt to EBITDA. But that could be accelerated. Again, the asset sales will help us pay down the debt and get us toward that targeted leverage ratio. But obviously, a lot of it's going to depend on the cash flows and how quickly we get through the pandemic and what immigration reform means to the country and the company.
I'll let you clarify here. There's a question. Is the $150 million in estimated net proceeds inclusive of the $20 million in net proceeds of the properties that were already sold?
Yes, we generated about a little bit north of $27 million in net proceeds from that asset sale. And so we've still got a ways to go, but we're confident that we'll get there in probably the first half of 2021.
There's a question here. Have you ever repositioned any of your real estate / facilities to be used as something beyond a correctional / detention facility?
Let me think about it a minute. I don't think we have, but I think, one thing that we've heard, and this is a little bit of the emphasis why we want to go back to a CCorp, is a lot of jurisdictions are thinking about, some of the aging of their population within their facilities and also with that chronic either mental health or medical. And so we've had a fair amount of folks come knock on our door saying, hey, we need a solution in XYZ jurisdiction. And maybe we provide the service and the real estate, or maybe just the real estate. But also maybe we could take an existing asset where it's got an overall kind of a mission, but maybe we could carve part of that out for a medical or a mental health solution. So we have nothing comes to mind, but I will tell you, we're really excited about this conversion because we've got a fair amount of opportunities we think we can follow through on now that we CCorp. And we don't have the prohibition on operating medical or healthcare facilities.
Real quick here, because we got about a minute to go. Alabama, obviously that one is been in negotiations and building some facilities for them. Where does that stand today?
So we're very honored to get selected. You saw the press release last, I guess it was September, from the governor on the announcement of the 3 facilities, and we've been selected for 2 of the 3. So we're still in very active negotiations with the state of Alabama. Not here today to say exactly what date that will be, but those discussions are very, very good, very strong, very encouraging, and we're hopeful with probably a few weeks, maybe some good news, but nothing yet to announce. But it's all going in a very positive direction.
Great. We have to wrap it up here, Damon and David. I will say this: there are a lot of questions on stock buybacks. So I know we can't address that right now, but a lot of people wanting to know when you might look or what measures you need to see in order to restart stock buybacks. As a lot of people think this is an attractive price to get in. But again, I want to thank both Damon and David for taking time out of their busy day to present at NobleCon 17. Very informative. We really appreciate you guys taking the time. We really look forward to seeing what happens here under the new administration and under the new CCorp. Again, thank you very much.